Hello and assalamu alaikum everyone. So let's pick up from where we left off, and all we have done up to now. Let's look at that. We have talked about published accounts, the contents of published accounts. We've talked about income statement. We have talked about statement of financial position. We've talked about ratio analysis. In that, we've talked about liquidity ratios, and we talked about profitability ratios. Now, before moving on to the limitations of ratio analysis, let's talk about how we can improve our ratio results. So let's go. Now in this slide you can see some points. Now these are all about improving your profitability ratios, methods to increase profit margins, the examples and evaluation method. This is taken from your course book, so you can just look at that as well. So let's go through this. Now one of the methods to increase, how can you increase gross and operating profit margin? That's the whole purpose of this slide. So we can increase gross and operating profit margin by reducing direct costs. Now reducing direct costs, that's pretty straightforward, right? You can just, how can you do that? You can use cheap material, that is rubber, not leather soles on shoes, like or perhaps switching your suppliers. Okay, that way as well you can have cheaper materials, but of course the quality will be compromised. Cutting labor costs, that is relocating production to low labor cost countries, such as Dyson making vacuum cleaners in Malaysia. Okay, countries where the minimum labor cost, minimum labor wages and salaries are low. Then cutting labor costs by increasing productivity through automation. Okay, you can just go to have some make some investment in your equipments, etc., your advanced machineries. That way your fixed cost will increase, but that would be just a one time or two time thing, because you don't have to pay, that won't be your direct cost. Okay, your cost, there will be one time investment, not a continuous outflows due to salaries. Or you can cut costs by reducing workers pay. Now of course each of these methods had some side effects as well, like consumer perception of quality may be damaged, and this could hit the product's reputation. Consumers may expect low prices, which may cut the gross profit margin. Okay, so if you use cheap labor, then all of this could happen. Okay, of course customers will want lower prices for that cheap product, and their reputation, that the image that the business has, that image would be destroyed. Quality may be at risk. Communication problems with distant factories. So if you just relocate your production to some other countries just to have a low labor cost, then that could also have some adverse effects on your communication, and your quality will also be compromised a bit. Purchasing machinery will increase overhead costs, that is gross profit margin will rise but operating profit will fall. Remaining staff will need retraining. Short-term profits may be cut. Okay, your short-term profit will be cut off, but still there is still hope for a long-term profit. Motivation levels might fall, which could reduce productivity and quality. So of course if you just cut off your wage, your workers won't stay silent, they will be in riot, and there's going to be quite an uprising and stuff, and it will cause, not just cause disruption, but the motivation levels of your workers will also fall, your productivity will decrease overall. So that is definitely not one of the good options. Okay, automation or relocation, automation or using cheap suppliers is still okay, but not the other two. Cutting labor costs or going to low labor cost countries, it's not easy to relocate. Relocation costs are quite heavy. So that was all about reducing direct costs. We can also increase our gross profit margin and operating profit margin by increasing price. Now if you increase price, of course raising the price of the product with no significant increase in variable costs, that is Mauritius Telecom raising the price of its broadband connections. Okay, so that way the total profit could fall if too many consumers switch to competitors. This links to price elasticity. So remember the price elasticity demand, that if you increase your price, your demand will fall. So that will of course happen over here, unless you are it's a necessity, or perhaps you have a very good brand image, or perhaps you are a niche market. Okay, so if you have that much good strong consumer base, then that won't happen. Petrol companies increasing prices by more than the price of oil has risen. Consumers may consider this to be a profiteering decision, and the long-term image of the business may be damaged. Okay, so now finally, increasing profit increasing operating profit margin by reducing overhead costs. Now, of course, if you reduce overhead costs, that will not affect your gross profit margin, but that will, of course, lower your operating profit margin, since that constitutes of your operating profit, which is the main cost of operating profit. When we were calculating operating profit, the main cost was your overheads, right? As if we deduct the cost, your overhead, your indirect cost from your gross profit, that's how we get our net or operating profit margin. So of course, if you reduce those overhead costs, your operating profit margin will rise. How can we do that? Cutting overhead costs such as rent, promotion costs, or management costs, but maintaining sales levels. For example, moving to a cheaper head office location, reducing promotion costs, delayering the organization. Of course, each of those will have an effect. So if we move to a cheaper head office location, there will be lower rental costs, which could mean moving to a cheaper area, which could damage image. Of course, if you just relocate to your simple, your lower rental cost area, but like it will be a cheaper area, so your image will be damaged, of course, unless you can just hide that or something, but that's not too easy. So of course, moving to a cheaper head office would mean your image will be compromised. If you reduce your promotion cost, then cutting promotion cost could lead to sales falling by more than fixed cost. Okay, that is basically that you might not even be able to reach your break even point, let alone make a profit. Okay, so if you're not even able to cover up your fixed costs, then how can you think about making a profit? You instead make up a loss. So we can't reducing promotion costs is not a good thing, especially in times where your sales are falling because of competitors, etc. The business is filled with competitors. Okay, it might be okay if you are a niche market or you have quite a good brand image, that your customers themselves promote your business by a good word of mouth. But if that's not the case, if just a regular business in a environment filled with competitors, then of course that's not a good decision either. And then we have delaying the organization. Of course, that will mean you don't have to pay more to your managers because you will have fewer managers, so lower salaries. But but that could also reduce the efficient operation of the business, right? Your efficiency could also reduce because you need if you had that many layers of organization, then that's probably because you needed some level of management. Okay, you needed someone to watch over the other employees, your subordinates, to have a certain flow of command. Okay, certain coordination and all. So there must be some reason that you have layered your organization. So delayering the organization is not a good thing unless you believe your employees will do well without certain level of management. Like, okay, some employees can do well without having supervisors. So in those particular case, it's okay to delay the organization. But otherwise, where you think that employees won't do too well if you delay the organization, then that's of course not a good decision. So of course, all of the decisions that I've discussed, they all each have their own side effect. So whatever the decision you have to suggest in a particular question, you have to look at the side effect as well before deciding, and then see which of the methods is the most suitable one. Now that was about the uses of profitability ratios. Let's talk about the use of liquidity ratios, how we can improve the liquidity ratios. So you can sell off your fixed assets for cash and lease them back if still needed by the business. So examples are land and property could be sold to a leasing company. Remember, leasing, sale and lease back, we've talked about that in the sources of finance chapter and in the cash flow chapter as well, that you could just lease them. That is basically a certain, you can renting assets for a particular limit of time after selling them, so you will have a particular discount as well. But if assets are sold quickly, they might not raise their true value. That is, you won't have a good enough cash inflow to do that. Selling your asset quickly, you won't have enough good amount of that asset. If instead you could have just waited for some time when that asset could be sold at a good price. But if you sold them quickly, of course you won't have a good price. And if assets are still needed by the business, then leasing charges will add to overheads and reduce operating profit margin. So your gross profit margin might improve, but your liquidity ratios might improve, but your operating profit margin will reduce. Okay, so that's just one of the side effects. And generally businesses do this sale and lease back to window dress their liquidity position. So if they are in a liquidity crisis, they can just do that, and they show that, oh, we are such a good business, we have good liquidity problem. That in the long run, that will be not, that's not a permanent solution. Okay, you can't just hide your liquidity like that. So that's not a good solution, and that's why, one of the limitations of a published account, that window dressing will be there. So there's that. What other thing the business could do? They can sell off their inventories for cash. This will improve the asset test ratio, but not the current ratio. Why is that? Because if you, like, selling inventories for cash will mean that you have more cash in hand, and in asset test ratio, we don't look at the inventories. We cut off the inventories from our current assets. So that's why that will improve your asset test ratio, but not the current ratio, because current ratio includes both inventories and cash. So if inventories in the form of cash or in the form of inventories, it doesn't matter in the current ratio, because that will still remain the same. So this method is only for improving your asset test ratio, your quick ratio. So stocks of finished goods could be sold off at a discount to raise cash. Okay, GIT stock management will achieve this objective. So if you have that particular thing, that you don't stock up your inventories, instead you just order them when needed and then just sell them, so that way you won't have enough inventories you will have instead directly cash. So this will reduce the gross profit margin if inventories are sold at a discount, of course, because if you are providing discount, your liquidity will improve, but then again at the cost of your profit margins. Consumer may doubt the image of the brand if the inventories are sold off cheaply. Okay, so if you're providing your stuff at a discount, then of course consumers will be like, why are they giving so much discount? Why are they selling you the stuff so cheaply? It was so expensive before. Why is it that they are just selling them off very cheaply? Their customer perception will be damaged. Inventories might be needed to meet changing consumer demand levels. So GIT might be difficult to adopt in some industries, of course, like perhaps there's a certain need for certain things. Okay, consumers are like, they can't wait for too long because GIT, remember we did discuss that it takes time and it requires a flexible workforce. So again, the limitation of GIT comes over here if you use that as an example. And what other method is there? There's an option for increased loans to inject cash into the business and increase your working capital. So if you use loans, you will have more cash and your working capital will increase. Why? Because cash is a form of current assets and working capital is current assets less current liabilities. So that way your cash will increase, but of course if you are taking loans, then that will mean that your future profit margin will be damaged as well. Long-term loans could be taken out if the bank is confident of the company's prospects. So if the bank knows that, okay, the business has a good profitability ratios, they had a good image and all, a good financial record, so the bank is confident enough that, okay, the business will be able to pay back the loan after long term. So in that particular case, you can easily have your loans, but this will increase the gearing ratio and also increase your interest costs. So interest costs basically damage your profit margins, cut into your profits, and gearing ratio is all about the certain thing that it increases the debt already on the business. Okay, the debts on the business. So that's the gearing ratio we'll discuss more in the A2. That's why it's written over here, chapter 35. It's in A2, but the basic idea is that your debts on the business will increase, because of which you can't ask for more debts. Okay, so if you take loans now just to improve your liquidity, you won't have enough loans to finance your further operations or make for certain investment or expansion and all. So that's the whole idea behind this gearing ratio point. And with that, we're done for today. I've talked about how to improve our profitability ratios. We've talked about how to improve our liquidity ratios. So thanks for watching. In the next lecture, we'll talk about limitations of ratio analysis. Although I was hoping I will be able to do both of them today in one lecture, but it took some time to explain these liquidity ratios and profitability ratios. Well, that's all. Allah Hafiz.